Good afternoon. My name's Desmond Lochman from the American Enterprise Institute, and it's my pleasure to welcome you to our virtual event on Can the Euro Survive? In 2010, in the wake of the great economic recession, the eurozone experienced a sovereign debt crisis. It did so as markets came to question whether countries in the eurozone's periphery, namely Greece, Ireland, Portugal, Italy, and Spain, could service their large public debt mountains. That in turn raised serious questions as to whether or not the euro would survive. In the event, the euro did survive, and the eurozone economy eventually did recover, albeit ever so gradually. It did so largely as a result of substantial financial support received from the IMF, the ECB, and the European Commission, as well as from result of Mario Draghi's famous statement in July 2012 that the European Central Bank would do whatever it took to save the euro. Today, some 10 years later, as a result of the coronavirus epidemic, the eurozone is again in the grips of a major economic recession, which is officially forecast to be the eurozone's worst economic recession since the Great Depression. The ECB is now expecting that eurozone GDP could decline this year by between 8 and 12%. Even greater GDP declines are expected for heavily indebted and tourist-dependent economies like Italy and Spain. It's discouraging that at this time, the eurozone is struggling to forge a united fiscal response to the crisis. It's also discouraging that the recent German Constitutional Court ruling is raising serious questions as to the degree to which in the future the ECB might be able to purchase a member country's government bonds. This is again raising fundamental questions in the market as to whether the countries in the eurozone periphery will be able to avoid restructuring their debts and whether the euro can survive in its present form. Against this background, it seemed timely to arrange an event that would focus on the following four questions. First, what must Italy do to generate economic growth and restore debt sustainability while still remaining in the euro? Second, how might the German Constitutional Court's recent ruling have circumscribed the European Central Bank's room for maneuver to respond to another European sovereign debt crisis? Third, how adequate has Europe's fiscal and monetary policy been? The response how adequate has it been to the crisis, and what reforms does the eurozone need to undertake to ensure the long-run viability of the euro? And finally, the fourth question that we'd like to cover is how much of a headwind might Europe be to the prospects for global economic recovery? We're very fortunate today to have some real experts to help us answer these questions. They include Professor Luigi Zingales, who teaches finance at Chicago's University Booth School of Business, and who is the author of a widely acclaimed Saving Capitalism from the Capitalists. He's also an editorialist for Il Sole 24 Ore, the Italian equivalent of the Financial Times. We also have Professor Athanasios Orphanidis, who teaches economics at MIT's Sloan School of Business. Athanasios has served as the governor of the Central Bank of Cyprus, and he's also been a member of the Governing Council of the European Central Bank. And last, but certainly not least, is Professor Ashoka Modi, who teaches international economic policy at Princeton's University's Woodrow Wilson School. He formerly held very senior positions in the International Monetary Fund's European Department, and he is the author of the very well-received Euro Tragedy, a drama in 9 acts. So with that introduction, I'll turn it over to my good colleague at the AI, Stan Feuger, who will be moderating the event.
Thank you, Desmond, and thank you to our panelists. Thank you all for tuning in. Please send your questions via the various routes that have been advertised if you want them to be asked by me. We're going to organize this in 4 different blocks, as Desmond announced, and we're going to start out by talking about Italy, and I wanted to give Luigi the opportunity to open the discussion of that important topic. Luigi, you want to go ahead for 5 to 10 minutes, and then we can have a moderated discussion.
Sure. Thank you, Desmond, and thank you, Stan. You're giving me in 5 or 10 minutes an impossible task: how to restore growth and make the debt of Italy sustainable. Also, just in case the 2 things were not difficult enough by themselves, staying within the parameter of the euro and staying within the euro. Let me start outlining why this task is so difficult. I think that the way I like to think about Italy is a kind of a bad version of Ohio. Ohio is the industrial manufacturing of America that was hit very hard by the China shock, cannot devalue with respect to the rest of the Union, and so face an enormous amount of unemployment and also despair. We've seen in the book by Angus Deaton and Ann Case how much of this costs in terms of human lives. I think that Italy has done a little bit better in terms of human lives. That's the only redeeming feature, and I think it's because we still have a functioning family that provides a informal network. But in a term of economic disaster, I think is much larger than that. And I will add 3 other things that make Italy even worse than Ohio. First of all, we're clearly behind in the digital revolution, and we can go for the cause of that. But there is no doubt that we are behind from a point of view of application, from a point of view of education. We have a super inefficient government. It's not that Ohio is Switzerland or Sweden, but it looks like by comparison to Italy. And in addition, we have a corrupt business elite. And if you go to the list of the major bankers and the major industrialists, etc., they all are indicted or condemned, convicted for corruption and other business shenanigans. So it's very hard to have a moral support of the rest of the population. So in this situation, as I said, what do you do? I think that the traditional, if you let me say, AI solution, which is deregulate and basically compress wages, is not going to work for 2 reasons. Number one, Italy has already a very low wage, at least the wage that the worker gets. Then, of course, there are the taxes. That's a different story, but a very low wage. And 2, in Italy, is particularly the northern part of Italy, is becoming a cesspool. And so if you deregulate even further, you're going to get all the pollution possible in the face of Earth, which, by the way, conflicts with the only real resources Italy has, which is tourism, which is affected very much by the COVID recession. But I think that is going to come back. It's not going to come back if we have a level of PMI index near Milan that is second only to the one in Beijing and New Delhi. So we cannot deregulate anything further. I claim we should regulate, but deregulate anything further is not. But most importantly is because I think we cannot compete on price with China. And even if China now is becoming more expensive, we cannot compete on price with Vietnam and Cambodia. So I think that the idea that the solution is just in compressing wages and trying to be the low-cost producer, I think there is no future. So what is the future? I think that the future is, first of all, a future quite a long time away. And I'm not so sure that we have the resources and the political will to do it, because it requires operating in multiple dimensions, starting from a qualification of education and a diffusion of education. I think that the level of education, especially in southern Italy, are extremely low. And roughly half of the workforce in southern Italy has at best a middle school degree. And I think it's impossible to compete in the 21st century with this low level of education. And the education to the digital world is basically non-existent. So we are very far behind that. we need a more efficient government, but this is easier said than done. And unfortunately, many of the easy solution, which is to pump more money into Italy, is going only to make the situation worse. And I think that we need also to reduce the fiscal burden that corporations have, because it's very non-convenient to do business in Italy when in Slovenia, which is the other side of the border. Actually, there is no border anymore. So the other side of the ideal border, or Austria, the taxation is much, much lower. In a sense, you might not believe to the Laffer curve in general, but I think the Laffer curve within a union, like within the United States, is a very real phenomenon. And unfortunately, I experienced that also in Illinois, because firms locate in Indiana and Wisconsin because it's much cheaper to locate than in Illinois. And that makes the Illinois situation much, much worse. And we've seen with Puerto Rico, when that burden became very big, everybody left Puerto Rico, and Puerto Rico to go bankrupt. So what can you do? I think that the solution is not what the Keynesian will like, which is massive government work. Why? Because number one, government efficient. Number two, the business elite is corrupt. So that is only reinforcing the bad coalition is still in place. The biggest waste in corporate history is the Mose project, 6 billion euro to try to save Venice. And after 25 years, is not working, and the adults will never work. And of these 6 billion, probably at least one end up in the pockets of local businessmen, and the rest end up wasted. So this is the kind of capacity that the Italian state has.
Luigi, can you clarify what this project is for people who might not be familiar?
This is as you all know, Venice is sinking, or the other way around is the water level is rising. And so pretty soon we have very high tides in Venice, and increasingly so. And so 25 years ago, actually, just to give you the timing of the Italian situation, 50 years ago, exactly 1966, there was a gigantic high tide. And after that, the Italian government said we should do something for Venice to save Venice. So it took 25 years to actually develop a project. And the project was very ambitious, is to create some kind of enormous balloon at the bottom of the lagoon that will inflate only when there was a very high tide, and will block the high tide from swamping Venice. And was called Moses was an acronym, but in memory of what Moses did in the Red Sea, that opened the sea with a tide or whatever. So I think that that's the project. It took 25 years to go from design to almost completion. Last year we had a gigantic high tide, and the Moses was not working. And so now people are doubting that we'll ever work, and all the money was wasted. So what is the solution? I think that the solution is actually to have a good unemployment insurance, so that you maintain consumption and maintain alternatives, and let sort of the entrepreneurs design new ideas with the understanding is they have to offer a wage higher than the unemployment wage, otherwise people will not work. And so that will force the entrepreneurs to actually create businesses that are high value added, because they can pay high wages. If we keep competing to the lowest common denominator, we're going to compete with Vietnam. We're going to have the level of per capita income of Vietnam. We don't want that. So that's the alternative. And in the process, we get rid of a lot of government spending that has been wasted.
Thank you, Luigi. Desmond, do you think this is a good path to follow?
Well, I think that what Luigi is raising, is kind of a serious problem, because it's difficult to see how Italy gets out of its debt problem. That's something Luigi didn't mention, that Italy's sitting on something now. It used to have 135% of GDP. Now it's going to be 160% of GDP. They're running a very big budget deficit. So that debt if we go to 2021, is going to keep on a path. If Italy doesn't grow, what it means is that debt just keeps accumulating. So it's difficult to see how Italy is going to keep this show going without the European Central Bank buying all of their bonds. And in fact, that's what we've been seeing the last couple of months, is that Italy had gross financing needs in April and May of 50 billion. And that is the amount of bonds that the European Central Bank has now been buying. So, you know, the only thing that I can see that keeps Italy within the euro is that the European Central Bank is just going to have to keep buying these bonds. And we're talking about huge amounts of money, you know, because Italy's gross financing needs during the government, should I say, the gross financing needs during 2020 is something like $500–600 billion, the same amount, if not more, the next year. And if the markets are seeing that this is not sustainable, the only way you keep this together is the European Central Bank buying the bonds. So, you know, my take on Luigi is that, you know, what he's telling us is that Italy's not going to grow, you know, the normal kind of way. It's not going to go the way Ireland perhaps did with a lot of reforms, get the economy going. So I don't see how they can service the debt.
Desmond, two things. One, number one, Ireland grew in part by being a gigantic fiscal paradise. So they took the Puerto Rico solution and they put it to the end. And maybe we should have done that in Italy too, but maybe it's too late to play in that game. Second, you're saying that the ECB, but honestly, the Fed does the same with the US government, and the Bank of Japan does the same with Japan. So you're saying if we want to stay in the euro, we have to have a ECB that is similar to the Fed and the Bank of Japan. If all of a sudden the Germans decide to run a central bank in a different way than everybody else in the world, we cannot stay in the euro. That's pretty clear.
Well, you know, my response to that would be that the Treaty of Lisbon has clearly an Article 123 that precludes the ECB from engaging in monetary financing. You know, that this was the whole idea, that the Germans, when they agreed to join the euro, they didn't want to have the ECB, the equivalent of the ECB, bail out countries that didn't have fiscal discipline, you know, that just, there would be no way in which you just stop. So they didn't want to lose the Bundesbank for an ECB that was just like a third world country central bank. So, you know, we've got a problem there, that you've got to have the Germans having the political will to have a full monetary union, and they don't really seem to be, so I say, to have a full political union, and they don't seem to have an interest in doing so.
So if you're saying that the euro was created in a way that was unsustainable, and that its unsustainability is becoming evident, we agree.
Yeah, no, my view was it was unsustainable from the start, but I think that now it's becoming very apparent that it's unsustainable, you know, because the only way that you can sustain this is to have the Germans agree to convert the European Central Bank into a bank that engages in monetary financing on a country where you can't exercise any budget discipline.
But Desmond, if a system is not meant to support or sustain an institution in front of a shock like the coronavirus, it means that it's unsustainable. It says institution needs to be resilient. And the euro was designed to fight an old war, the war against inflation, and it's never thought about all the other potential shocks. So it was conceived in a backward-looking fashion.
Ashoka, I saw you nodding. Do you think the eurozone as currently set up is unsustainable?
So may I just step back for a second and just give? So I loved what Luigi said. You know, I'm like in 1000% agreement with him. I'm going to do a little bit more initially, at least a short-term view, which is where Desmond started. Just to, you know, putting on my old IMF hat and saying, you know, what is the short-term outlook? To make 4 points quickly. My reading of the data, as well as of my understanding of the health crisis, is that we are not going to see a V-shaped recovery anywhere. That the recovery is going to be slow and shallow, that this is because both of medical reasons as well as technical reasons. Medical reasons is simply that the opening process has to be slow, and the technical reason is that the economy is like a system of cogs and wheels, if I get that expression right. And so if you open a restaurant 30% capacity or 40% capacity, it's not clear that the restaurant is viable. And certainly it's not clear that its suppliers are viable. And so the entire supply chain becomes a problem. And then if you then extend that to the fact that this has affected not just one country, but the entire world at the same time, then supply chains globally are disrupted in a very real sense, in that when I am ready to supply, you are not ready. You, my traditional importer, are not ready to buy. When you are ready to buy, I'm not ready to supply. And so that lack of coordination in timing is also going to create long delays in the recovery process. This is true everywhere. What is also true everywhere is that we have come into this crisis with a globally slowing economy, so that there were structural forces that were slowing the economy down. Number three, we have come into this crisis with an unprecedented debt levels, debt of all kinds. And Luigi is an expert on this, so I'm very much hoping that he will weigh in on this. That corporate debt levels are high in many countries. Household debt levels are high. In Europe, Germany is the one country that has a modest sovereign debt, but other countries have very high debt levels. So this crisis has started as a economic crisis, unlike the 2008, 2009 crisis, but it seems almost inevitable that there will be a financial crisis that will follow, which will also delay the recovery. So given the fact that this is true everywhere, and we are already beginning to see stress in the emerging markets, my further proposition is that in all these regards, Europe is worse off. Europe has a much lower long-term potential growth rate. Europe was in almost recessionary conditions before coming into the crisis. And Europe has extraordinarily high debt levels. Plus, the European system relies hugely on the banking sector, where despite the fact that the banks had made progress during the period after the eurozone crisis, banks were still very fragile. If you look at the market to book value ratio, which has been consistently less than 1, where markets were essentially saying that if you may think you've got 100 euros on your books, we think you've got 30 or 40 euros on your books. And some of the banks, particularly Deutsche Bank and Commerzbank, have pathetically low market to book valuation. So can I just finish one last thing before so there are problems everywhere. There are problems more deeper in Europe, and there are even deeper problems in Italy. This is why Desmond and Luigi focused on it. In all of these respects, in the short term, Italy is much worse off. It has much lower potential growth. It has not grown for 20 years. It was already in recession. It's got very high debt levels, especially at the government level. And there is no fiscal policy that is possible. My understanding, my reading of the data is that this year, the Italian GDP could contract by between 15 and 20%, which will blow up the debt ratios close to 190%. The gross financing needs, Desmond has already talked about. Since there is no fiscal policy, despite the talk in Brussels, everything resides in the ECB. And while the exchange between Desmond and Luigi Desmond saying that the ECB should, and Luigi saying, yes, that's the only game in town. It's true, it's the only game in town. But the legal and political barriers to the ECB acting over the next 6 to 9 months are going to be extraordinarily high.
Well, that's an outstanding bridge to the second part of our conversation. The question Desmond posed was, how might the European Central Bank's room for maneuver respond to another sovereign debt crisis, if there is to be such a thing, or more generally to, buying up Italian and other types of sovereign debt? How might it be limited by the German Constitutional Court's recent ruling? And for that, I'd like to turn to Athanasios, who I believe has some slides ready for us to go. Let's see if the technology cooperates here.
Yes, thank you, Stan, and thank you, Desmond, for putting this together. I actually wanted to intervene and get in the discussion that Desmond, Luigi, and Ashoka just had, and let me actually do that for a minute before I start. I have to say that even though I agree with the statement that Ashoka and Luigi both mentioned, Italy is in a very difficult position because potential GDP growth is quite low and lower than in many other countries. In my view, with good monetary and fiscal policy, and we can discuss which. If fiscal policy is not forthcoming, as Ashoka pointed out, I think monetary policy can actually do the trick on its own. If you have a properly functioning central bank, you can overcome the problem. And the reason I say this is because when it comes to debt sustainability, and this is something that we see in all of the advanced world right now, we need to pay attention not only on potential GDP and the level of debt, but we also need to pay attention on what is the cost of refinancing the debt, which depends very importantly on the equilibrium real interest rate, which is at historic lows. And when we have equilibrium real interest rates at around 0, which allow the Bank of Japan, for example, to keep the cost of financing of the Japanese government to negative interest rates. If the ECB were to operate in a way that is at least as good as the Bank of Japan, we would not have a debt problem in Europe, not even in Italy, because of the equilibrium real interest rates being so low. All it takes is to have some positive growth. And even though potential output growth in Italy is low, I don't think anybody has made a case that it's negative. So I would not worry that much about that. I would worry more about whether we will be able to see the good policies, and as was just pointed out, whether we're going to have legal or political constraints effectively restricting the options or making it harder for the ECB to do what would be normally a reasonable policy. So I have a few slides just to comment, as Desmond had asked me, on the German Federal Constitutional Court problems that have been created. I hope the technology is going to cooperate with us on this. So let me start with the decision on May 5th. And the first thing I want to do is point out that the German Constitutional Court did not address its decision to the ECB. It addressed its decision, as you see here on the first line, to the federal government and the parliament. And effectively, what the German Constitutional Court said is that the federal government and the German parliament should have challenged the ECB because, in the German court's view, the ECB did not substantiate that it met the criteria when it started doing quantitative easing. But that's a very important point to make here, is that this is a decision addressed to German institutions, not the ECB per se. Now, what makes this decision very strange from a European perspective is that the legality of the ECB's quantitative easing had already been ruled upon by the European Court of Justice, or officially the Court of Justice of the European Union, in December of 2018. And the European Court of Justice found that the ECB was entirely within its legal authority to engage in quantitative easing, which frankly, to most, if not all economists outside Germany, is kind of a natural view. You do quantitative easing as monetary policy, and quantitative easing means that you buy government debt. And indeed, the German Constitutional Court did not question that there was any hint of monetary financing or any of the concerns that Desmond pointed out before. That's not the issue at all. What is really weird here is that the German Constitutional Court effectively said that the European Court of Justice's decision, if you can see this here, is not comprehensible. This is what they actually stated in their decision. And as a result, the German Constitutional Court said, so this judgment that QE is valid, it doesn't stand because their decision is not comprehensible. And to put this in perspective, I want you to envision some court that has authority in the Commonwealth of Massachusetts, where I'm joining this webinar, challenged the Supreme Court of the United States and said, "You guys have no idea what you're talking about. So this decision you took doesn't make any sense, and we will overrule it." So this is what makes this strange issue and creates the problems right now. But if you actually look at it in terms of whether the decision is absurd or reasonable, you have to put this in the context of, well, what's the basis of the evaluation? If you take a European perspective, this is clearly absurd. The whole point of having European institutions is that we have one court, the European Court of Justice, that is the only court that can question the legality of European institutions like the ECB. And it's absurd that the court of any individual member state could overrule the European Court of Justice or even suggest anything to that end. But if you actually look at it from the perspective of narrow German interests, the German Constitutional Court decision is entirely reasonable for the following reason. The German Constitution, the basic law, simply has a flaw when you look at it from the European perspective. It does not recognize the supremacy of the European Court of Justice over Germany's own court. So this is a flaw that, as far as I know, we don't have that in other countries. We don't have other European countries whose own courts have questioned in this way the supremacy of the European Court of Justice. But if this is the German constitution, then it's entirely reasonable that the justices in Germany would say, well, the ECB did something, quantitative easing. Quantitative easing has side effects. I think we can all agree that any policy decisions, including quantitative easing, has side effects. And then the next step is, oh, we have German citizens that are complaining that they are adversely affected by these side effects. So yes, we have the authority to look into this. And if you look at it in that perspective, you can see that the issue here, and both legal and political issue, is really about why is it the case that Germany has this exception that somehow it has not been already corrected in its own constitution, as has been the case in other countries. That there should not be this dispute about the supremacy of the European Court of Justice when evaluating ECB decisions. And this takes me to the next point, which is my biggest worry for the European context, and goes back to the discussion we had about the ECB. All central bank decisions have distributional consequences. And the problem in a monetary union is that the ability to influence the common central bank can actually change outcomes. And if interest in one member state can influence the common central bank in their own way, they can actually influence outcomes to be in the benefit of the citizens of that member state and against the interest of the union and other member states. And this is where the politics and the legal issues become very important. Now you're going to say, can core challenges be an effective tool for influencing policy if you already have a nice independent institution that knows that in theory is only bound to the decisions of the European Court of Justice? And the answer is that, well, you know, all institutions, including independent European institutions, are run by people. And it's entirely understandable that the people who actually have the responsibility to take decisions at an institution like the ECB may be quite concerned about the legal challenges coming from the court of a member state that is very powerful and that, as of now, still disputes whether the supremacy of the European Court of Justice over ECB decisions. So this is the issue that I see troubling the European Central Bank. Now the question is whether this could influence in the future or has already influenced ECB decisions. So this is the setting, and clearly you can tell from the way I've been presenting this that from a European perspective, and yes, I'm European who lived most of my life in the United States, but I'm European, so I have that perspective. From the European perspective, there should be no room for challenges by any national court to ECB policy. But in fact, we have these challenges, and the question is what effect they have. Now, what we have seen in a very nice interview a few days ago by Isabel Schnabel, a German national who is a member of the executive board of the ECB, just appointed a few months ago, in her capacity as a European official, not as a representative of the German government. And this is one of the beautiful things about the European Central Bank when it's acting correctly, actually made some statements about this. And she pointed out quite correctly what should be the answer to the puzzle, that ECB policy should not be adjusted in any way in response to this ruling. And she pointed out that, first of all, it's only the European Court of Justice can actually rule on the legality of ECB decisions. And also, as I pointed out to you earlier, that the court decision isn't really addressed at the ECB; it's addressed to German political institutions. But of course, if this does not play well inside Germany, it can create havoc. And even though it's absolutely the correct answer to say that the ECB should not be influenced by this decision, there remains the question: could it be that the legal challenges on the ECB have already influenced ECB policy in the past? And let me show you what I mean by that. Well, we know the primary objective of the European Central Bank is price stability, and this is a picture of the inflation rate in the euro area. You can see this is monthly data until last month, and what I have here in the black line is the average inflation rate in the Dijsselbjerg-Trichet era, and you can see it's actually exactly 2%, very close to the ECB's definition of price stability, which is to be close to 2%. But you can also see that since Mario Draghi's tenure started, the average has been almost 1 percentage point lower. And clearly, we have a tension here. It appears that the ECB has not been pursuing the policy that is compatible with meeting even its primary objective. I will not even go to secondary objectives and so forth. And this raises some question: how does this relate to the challenges we have in the euro area that I just mentioned? Well, one thing I will start from is let me show you a brief comparison of the Federal Reserve and the ECB policy. One of the major challenges for most advanced country central banks since the 2008 crisis has been the encounter with a zero lower bound. You can see both the Fed and the ECB and a number of other central banks have pretty much kept interest rates extremely close to zero. Going negative for the ECB has been quite controversial. Part of the controversy it had faced. The Federal Reserve only managed to escape the zero lower bound for a couple of years, and now with the pandemic, we got back. So what do you do when you're at the zero lower bound? What is the natural monetary policy response to ease policy sufficiently to make sure you have the right inflation rate and you don't undershoot all the time? Of course, we know the answer to this since Keynes in the 1930s, who first started describing quantitative easing in the modern terms. And the answer is that you need to move to balance sheet policies. And here you can see a comparison of the size of the balance sheet of the Federal Reserve and the ECB. These are trillions of dollars for the Federal Reserve, trillions of euros for the ECB. And you're going to see that the ECB has hesitated quite a bit in raising its balance sheet. It raised a little bit, then you can see a terrible monetary policy mistake. It shrunk its balance sheet from 2012 to 2015. Then it started quantitative easing from 2015 and so forth. And even now, mind you, this is a concern we should have for the present. The ECB has only expanded its balance sheet by about 1 trillion euro. Compare this with a massive increase of the Fed's balance sheet to understand why perhaps we should be concerned about Europe along the lines of what Ashoka pointed out earlier on, unless policies change. So what's going on here? Well, this period where we see these issues with ECB not managing to increase its balance sheet enough is exactly the period where German interests were legally challenging ECB policies at the German Constitutional Court. And apparently, we don't know this for a fact, we cannot disprove this, we can only look at the data. Apparently, this was sufficient to contain the balance sheet expansion that the ECB should have done and kept inflation low. And let me also mention something else on the...
Athanasios, can you try to wrap up? Sorry. Yeah.
Sure, I have two more minutes. I want to show you the distributional consequences of this that are quite important. One thing to say is, what is the ECB trying to do? Well, clearly, it should have been focused on achieving close to 2% inflation for the euro area as a whole. But actually, the performance in practice has been quite different. So since this is about Germany, I can split the euro area into two parts, Germany and euro area excluding Germany. And what you can see from this picture is that the ECB has been pursuing a policy that has actually kept German inflation very stable over the last 20 or so years. The average in the two periods I highlighted before is very small. It's quite trivial in the two periods. Whereas if I look at the euro area excluding Germany, I have this 1 percentage point plus difference in the inflation outcomes. So this suggests that ECB policy may have been unduly influenced in a counterproductive manner. And of course, this has distributional consequences on the rest of the economy. Let me just show you a picture comparing the unemployment rate. You know, if we were in the United States, this would have been standard thing to do for the central bank. This is Germany's unemployment rate. This is the euro area excluding Germany's unemployment rate. This is not only ECB policy, this is ECB policies and other policies, but you can see that something is not working very well in Europe. And let me conclude by pointing out that I worry about the euro area because in its current form, the euro does remain a threat to Europe. The key for success is to find a way to share prosperity and find a way to use the policies of the common institutions to promote a common good. It's very, very important in accordance with the treaties for Europe's independent institutions to counterbalance narrow national interests. And one of the concerns we have in the aftermath of the German Constitutional Court decision is that things, if anything, may get worse. Now, if I want to be optimistic, I would say that this may be a wake-up call that actually moves the system in the other direction, counterbalancing past biases in order to normalize Europe going forward. But only time will tell us whether we will get a good outcome.
So do for the other panelists, do you agree that the European Central Bank has been constrained in a way by legal challenges over the past decade? Do you think that's an active ingredient of policy making? And do you think that explains some of the figures we just saw?
Is Luigi going or should I go?
You can go ahead.
Okay. The short answer is yes. The longer answer, which Athanasios sort of played around this idea, but did not quite say it. The ECB is not a normal central bank. You know, we compare the ECB with the Federal Reserve, we compare the ECB with the Bank of Japan. That unfortunately, that comparison doesn't work, because the ECB is the central bank of a confederation of states. There is no political authority. There is no federal authority which the ECB deals with. And so, because it is a central bank of a confederation of states, it will inevitably have to weigh the different interests of the different states. You know, Isabel Schnabel and others might very sort of idealistically say that it's a European institution and so on, but what does Europe mean in this context? Europe means a confederation of states. What Athanasio did not show you also, but again he came very close to doing so, is that the German inflation rate has been close to 1.5%. The Italian inflation rate is dangerously close to zero. It's been 0.5% or less. So we are at a stage where the differentials between the nation states, between what constitutes this confederation, have increased. Therefore, the notion that there should be a 2% benchmark is sort of is an interesting anachronism, but it's not a very helpful guide for policy. Therefore, we are going to have a severe problem, which is that I don't really think of the German Constitutional Court as the necessary problem over here. The German Constitutional Court is reflecting a political viewpoint in Germany. And the political viewpoint in Germany is, we don't pay the bills of other countries. That is essentially the guideline of under which Helmut Kohl proposed the euro, and that is the guideline under which the Bundestag accepted it. Therefore, we will be unfortunately forced to deal with this following question, which is that over the course of the next 6 to 9 months, the ECB will buy lots of bonds of the Italians and the Spaniards. Going into the crisis, ECB already had 23% of Italian bonds. And I expect, just numerically extrapolating now based on the refinancing needs, that by the early 2021, ECB will own something between 40 and 45% of Italian debt. At that point, the ECB owns Italy. The ECB is then the single largest creditor to the Italians. And the question has to be asked and faced squarely, which is, at that point, given the poor recovery, given the deflationary forces within Italy, if the Italians are unable to repay their debt, will they default on their private creditors, or will they default on the ECB? And if they default on the ECB, then it's not like the Bank of it's not like the Japanese Treasury not repaying the ECB. the Bank of Japan, or the US Treasury not paying the Federal Reserve. This will be one member country not paying its obligations. Those numbers will be reflected in what are called the target 2 balances, which will mean that there is every reason why the Germans fear that an Italian default is going to cause losses imposed on them.
I think Desmond would like to jump in.
Yeah, I think I agree much of what Ashoka said, but I'd add that the European Central Bank is different from the Fed in that it's bound by the Lisbon Treaty, and the Lisbon Treaty Article 123 indicates that there's not to be monetary financing of a government's debt. So if we get to a situation now where the European Central Bank is only buying Italian and Spanish bonds, basically what is going on here is that the European Central Bank is allowing Europe to move to a fiscal union through the back door. And this is something that, at every occasion has not been accepted. This is something that really needs to go through the German parliament. I think this is a legitimate legal issue. And this is the kind of thing that the Europeans are going to face going forward, is that you cannot have, up till now, there hasn't been a problem because the European Central Bank, in doing quantitative easing, has been sticking to the capital key, so it's not favoring one country over another. It can pretend that it's not engaging in government financing. But when you now shift to a situation where you're just buying one country's bonds, it's very difficult to see how that doesn't violate Article 123. And I think that the Germans have a legitimate cause. Just one other point I'd want to make, because I think it's an important point in terms of debt dynamics. I think that there's too much discussion about if interest rates are low and growth is high, that you can have a situation where debt sustainability is not a problem. What we're forgetting is that Italy is running a huge primary budget deficit, and that is driving the debt. So even if the interest rates are low, you can have
Desmond, this is absolutely wrong. I'm sorry to say this, but for the last 20 years, Italy has been running primary surpluses in each and every year except 2009. I don't think any other country in the euro area has been as fiscally careful as Italy when it comes to primary surpluses.
Yeah, but this is precisely the point, is that now, because you're having Italy having a crisis of the size that it's having, Italy is going to be running a primary budget deficit now of something like 8% of GDP. For debt sustainability, Italy needs to get a primary surplus of 2% of GDP. How is Italy going to do that fiscal adjustment in a fixed exchange rate system? I mean, that is the basic problem as to why this arrangement is not a sustainable arrangement, that you've really got to have the ECB buying their bonds and then it's violating monetary financing.
Luigi, we're back to your original assignment of Italy's debt sustainability. So.
Yeah, no, but what Desmond says is absolutely right. This proves the point I said at the beginning, is that the design was flawed from day one. Because if you want fiscal balanced budget at a local level, you need to have a mechanism of intervention when there's a major shock. It's just the US states have some form of mandatory fiscal balance. Not that they follow it very well because Illinois is a disaster, but they do have some measure. And when Louisiana is hit by Katrina, the federal government is sending 27% of GDP of Louisiana in aid. So I think it's very easy to say how we fix it. The Germans pay for it. And they should, because that's what is called being a nation. If you don't want to do that, you should not be called a nation. You should not have the same currency. And I think that's simple. And the second point that I think that Athanasio made very clear and is very important is say, look, the debt is sustainable if you had a commitment to be a real central bank and not a puppet in the hands of the Germans' constitutional court. I think with a real central bank, we can have an inflation target at which at least 2%. And by the way, we have at least 10% to catch up for what is left. So we should have at least 1 or 3% for the next 10 years. So we should have that as a target, because that's what's called price stability. And with that target and a little bit of effort on the Italian side, maybe we can make that sustainable. If we start to question that, then becomes a self-fulfilling prophecy. And I think that what I fear the most is that we're living since 2010 in an equilibrium in which the Germans are not willing to make the step to jump fully into a union, but not willing to renounce to the enormous benefit they receive from this union. And so they keep going back and forth. And in the process, they are subjecting Italy, most countries, but in particular Italy, to a waterboarding process. And by the end of this waterboarding process, we'll have no Italy, okay? And we'll have, all the Italians will be abroad, and we'll have no Italy.
So this, I think, certainly addresses Luigi's view of how adequate Europe's fiscal and monetary policy response has been to the crisis so far, which is Ashoka's assigned topics. I think let's move to that third part of our conversation, which is the current fiscal and monetary policy response to the crisis and changes that you'd like to see in institutional design around those two responses. Ashoka?
Yeah, so, I can briefly talk to that. Let me just sort of preface it by saying that there are two Europes, the one we would like and the one we have. The one we like is the one in which there is fiscal burden sharing. There is some notion of doing the fiscal transfers on the order of magnitude that we have just talked about, or we can deal with the Europe that we have. The Europe that we have is not just to be clear, not just a matter of Germany. The Europe that we have has the Dutch, the Austrians, the Swedes, the Danes, and believe me, if it comes to it, the Eastern Europeans and Ireland. The fact of the matter is they cannot agree on anything, on tax policy, on migration policy, on what you might think is sort of basic stuff. So let's just briefly consider this so-called recovery fund that has just been established. Or, sorry, not been established, excuse me, that has been proposed.
Comment.
Yes, so it is a pure rerun of a debate that has occurred in Europe over the last 70 years, that monetary union needs a fiscal union. Yes, so Pierre Werner and his colleagues knew that in 1970. And they said so in very sort of explicit terms. And the Europeans could never agree on that. So they've gone through this debate a million times over the last 70 years. Every few years they do it, and a few years in somewhat different words, with somewhat different language, but it's the same debate. So now they want to borrow. And somehow borrowing seems some kind of magic, because suddenly now we will have 750 euros to play with. Yeah, but you have to return that money. You have to repay that money, for heaven's sake. Who is going to repay that money? And how is the burden of repaying that money going to occur? And you're already now in a position where four countries, so-called frugal four, whose identity, by the way, has remained unchanged through all these years. This is the one thing about history. You have to ask yourself, is something going to happen today that has not happened in the past several iterations? If it has not happened in the past several iterations, what were the incentives then? Have the incentives changed now? And the answer is no. Let me just add on the incentives being not changing, that believe me, France, when it comes to paying for this recovery fund, the so-called Franco-German proposal, Emmanuel Macron stood side by side with Angela Merkel and they had this big photo op. You think France is going to pay into the recovery fund? The French are going to run a budget deficit this year of 10 or 12% themselves. If asked then to also contribute 2% to Europe, they will say, are you kidding? Therefore, A, I don't expect this fund to happen. B, if it does happen, even in the best scenario, the money through this fund will flow into Italy in 2022, 2023. That is the current European Commission plan. I'm not making this up. These are the numbers. Therefore, the question is, Italy is bleeding right now. So you're a trauma patient, you go into the emergency room, and the emergency doctor says, yeah, that's all fine, but your problem is that you're obese. And so come back in 6 months' time with a plan of how you're going to get rid of your obesity. And at that time, we will take a few months to evaluate it, and then we will tell you over the next 2 or 3 years what money we can give you to subsidize your gym fee. That's essentially the fiscal plan right now. Now, therefore, we have to keep coming back to the theme that Desmond started with, Luigi reinforced, and Atanasio has again reinforced, that the only game in town is the monetary policy. And the monetary policy has escaped from this trap because of the super independence of the ECB. So it is technically correct that the ECB can print as much money as it wants. And it can therefore do all the things that central banks do. But the ECB will ultimately be bound by the fact that Europe is not what we want it to be. Europe is not a nation state. We may want to think it is a nation state, but it is not a nation state. And
so Ashoka, to push back a little bit on that, if you expect France and a number of other countries to run deficits that are 10% of GDP, doesn't that mean that monetary policy is in fact not the only game in town? That's a very different situation from what we'll see here in the US, for example.
Right. So the running a 10% fiscal deficit is not fiscal policy. Remember that the 10% fiscal deficit is arising purely because of the sharp fall in output and therefore the sharp fall in revenues. Fiscal policy is once you know that your revenues are going to fall in any case because of the sharp fall in output, then you counteract that with discretionary policies. That is fiscal policy. The question is there any country in Europe other than Germany and maybe some of the frugal four who can have a discretionary fiscal policy that recognizing that its budget deficit is going to balloon because of the sheer decline in output is nevertheless willing to increase its deficit even more to counteract the effects of the output decline? And the answer, Steve, say one last word on this. If you look at that, if you look at it from that lens, then remember the United States, which is a much stronger economy, and despite the entire mess on the health crisis and also on the fiscal crisis, the US is going to have a fiscal stimulus, something in the range of 10 or 12% of GDP. Germany, in the end, will probably have a fiscal stimulus of something in the same range, 7 to 8 to 9% of GDP. Italy, which is going to have a much larger decline in output, cannot afford a fiscal stimulus. Because even as I think either Atanasio or Desmond gave the numbers, right now the Italian spreads are not increasing only because the ECB is buying up whatever the Italians are willing to offer. But even so, the interest rates are high. If the Italians were now to say, which they should, that we need a 10% fiscal stimulus on top of the fact that our deficit is in any case increasing to potentially make our fiscal deficit something in the range of 15 or 18% of GDP. That is what is needed. That's why fiscal policy has to be much more aggressive in a normal situation, but it has to be backed by a central bank. And that's what's happening in the US with all its imperfections. And that is something that simply cannot happen in the Europe we have.
Athanasios?
I agree with a number of things Ashoka said, but there's one fundamental point of disagreement.
Yes.
And I will split it into a few pieces. First of all, quantitative easing is not monetary financing. And Desmond also pointed something along these lines before. And I want to remind you, we even have the decision of the German Constitutional Court saying that in their view, the ECB's quantitative easing is not violating at all the monetary financing clauses. So that's one element.
That's because
but the issue I want to focus on Ashoka's remark is, can the ECB be a normal central bank, whatever we define a normal central bank to be, and is the ECB a normal central bank? Well, in my view and my reading of the treaties, the ECB can be a normal central bank. This is, in theory, completely up to the governing council of the ECB. And let me remind you that members of the governing council of the ECB serve in their individual capacity. This is what the law says. They're not there to serve as representative of any countries. And this is why Ashoka was right that there is no federal government to be the counterpart of the ECB. But the founders of the union realized that, and this is why they put these institutional structure features for the ECB setting to make it feasible for the European Central Bank to operate as a proper central bank, even though we are in a confederation and not in a federation. So technically, the ECB can operate as a proper central bank. The question is, does it always operate as a normal central bank, and is it completely free of political influences? Well, no central bank can be completely free of political influences, and this is why the political tensions matter, and this is why the court decision matters. But if I wanted to be optimistic about Europe, I would say that, and this is quite different from Ashoka's prescription, that in my view, if the ECB focuses on its mandate and acts as a normal central bank, which it can do, that alone, in the current configuration of real interest rates and growth, is enough to ensure that all member states of the euro area are sustainable, for the same reason that Japan is sustainable and the United States is sustainable. If you have an equilibrium real interest rate that is about zero, it only takes minimal real output growth to be sustainable, as long as Luigi pointed out before, the central bank does its job to avoid having self-fulfilling prophecies that are reflected in the cost of refinancing of government debt. So it makes a huge difference if the ECB does its job correctly and does not let unnecessarily Italian yields or Spanish yields or French yields or anybody else's yields rise for no good reason, when the equilibrium real interest rates are so low that evaluated at those levels, everybody's debt is sustainable. And it does make a difference if you can keep interest rates low, as it's feasible, if you remove the unnecessary premia. That actually creates a lot of fiscal space that can be used for the fiscal expansion, where a point I agree with Ashoka, is very important to have a fiscal expansion in the current circumstances to fight the pandemic. This is a temporary response, and it's very important not to make the same mistake we made in the euro area back in 2010 and 11, when institutions in the euro area created a second recession by having tight fiscal and tight monetary policy at the same time.
Desmond, do you think that if the ECB operated in that way, that would make the fiscal constraints go away in a sense?
Well, I mean, I think that it's all hypothetical, because I think that what distinguishes the ECB is it's governed by a treaty. And, I disagree very much with what Athanasios says. Up to now, you can say that it was quantitative easing. It wasn't monetary financing of government deficits because they stuck to a key. They were buying 30% German bonds, 20% this country's bonds, and so on. They weren't directing it at an individual country. And that's where we're going right now, which is something I would agree with Ashoka, that you don't have a central bank in Europe that can do that kind of job. It's not set up that way legally. It's not entitled to do that. But there's another point that I want to make, which I think is really pertinent to the discussion, is that what we're seeing in Europe in terms of inflation now is we're seeing very low inflation overall in Europe, but we're actually seeing deflation in Spain and in Italy. That's something like 0.7, 0.8% was Spain, 0.3% negative was Italy. And what I contend, I think this is something that people are not really thinking about, is that this recession that we're having in Europe is 3 times as bad as the previous recession. We're talking about something like the Great Depression. And my question would be, it's not just for Europe, but it's also for the United States. If you've now got gaps in the labor and output markets that are reminiscent of what we had in the 30s, I'm not sure that I see why we don't get the deflation that we got then, and that compounds the whole deficit problem. So, what in the context of Italy, what we're going to see is we're going to see Italian spreads being around about 2%. On top of that, if they have deflation of 1 or 2%, we're now talking about real interest rates. You add to that the primary budget deficit, and you're on a very explosive path on the debt. So, I don't see how this all adds up.
So before we turn to our last topic, I wanted to ask basically everyone but Ashoka, do you all really think there will not be the announced joint borrowing for fiscal policy? Is that?
I think Luigi wanted to get a word in.
Yeah.
Yeah, and it seems a bit that Desmond is talking like a German lawyer, because you go so much by the norm, but you're American, and you know that the U.S. Constitution allows sort of the Ferguson opinion and the Brown versus Board of Education. Okay, so those are completely different decisions from the same Constitution that has not changed because people are different. And what I understand, I'm not a lawyer either, but what I understand from Athanasios is that there is plenty of room in the existing institution to play a different game. And by saying that you're bound to the law, you're basically playing their game because they're not bound by law. They could play a different game. They just choose not to. And they choose not to because they don't want, and that's the problem.
No, I think that you're absolutely right that they could change the game, but that is a political decision that the Germans haven't made. So when they joined, so if you want to go that way, this is something that we should do. We should take this to the Bundestag and have them to vote. Do you want to have monetary financing of Italian debt? We
don't need it.
You do need it. You've got Article 123. How can you just buy off the capital key? This is a problem that you're going to run into right now. This is something that the court hasn't just considered this time around, but now it certainly will. If all that the ECB is doing is it's buying Italian bonds, that is not quantitative easing. That is monetary financing of the government debt. But just going to the question that Stan asked, that I would guess that you're going to get a compromise with the Frugal Four. You're going to get this bond package agreed, but what you're going to do is you're going to change the composition of it, that instead of this being grants, what you're going to get is this being mainly in the form of loans, which is a very different animal.
Yeah, if it is in the form of loans, then it's not fiscal stimulus. That's the bottom line. because the loans only increase your indebtedness. They do not decrease your indebtedness.
Right. So I'm saying that that's where the compromise will come.
Yeah, and as Luigi said,
this is not a compromise. This is basically a victory of Northern Europe over Southern Europe.
correct.
I don't call it a compromise. A compromise means that you go halfway. I don't see it halfway.
Well,
No,
Anastasios, sorry.
if I say so, Luigi, I agree with you that if that were the case, that would not be a compromise. But I don't agree that this is Northern versus Southern Europe. I actually think that the agreement between Chancellor Merkel and President Macron is an important agreement, and I hope and I'm confident that to a very large extent it will go through the European Council. So it will not be all in terms of loans, because I agree with Ashoka, then it wouldn't really do anything. So this is a one step forward moment, and because the chancellor is behind it, this is why I wouldn't see it really as North versus South. This is a recognition that the circumstances are such that you can no longer be constantly hiding behind something that's unworkable, and you need to make some progress. Of course, it's temporary, it's a one-shot thing, and unfortunately it's coming too late. So I wouldn't count on it for actually arresting the recession that we have ahead of us. This is why I continue to put my bets on the ECB stepping up to plate and doing its job if we want to have outcomes in Europe that are going to be similar to the outcomes we're going to have in other advanced economies.
So as a frugal four citizen, can I ask for clarification as to why joint borrowing wouldn't do anything? Wouldn't it secure lower interest rates for the non-frugal member states? Isn't that exactly what, for example, Athanasios wants to accomplish through the monetary policy route? Doesn't it create fiscal space?
Yes, so let me make two comments. One on your question, Stan. It does. Let's be clear about that. But remember, the Italians borrow something in the range of 500 or 600 billion euros every year. And if on a slice of some 20 billion euros, they get 0.5% instead of 1.5%, that's helpful, but it's not going to improve their debt dynamics. But let me just go back to the point that Athanasio was making, that this is a small step forward. The reason it is not, remember, Chancellor Merkel is a very sort of diabolical politician also. She has thrown this into the snake pit of the European budget discussions, where there is going to be, in any case, where there has been over the last 18 months or more, a fight over pennies relating to agriculture, relating to cohesion funds. Now what she is saying is, okay, put some more money into it and let's fight about that too. The problem over there, as I keep insisting, we have to recognize, is that yes, the money will come in initially and you will give out low interest loans, but that 750 billion or 500 billion will have to be repaid. Who is going to repay that money? And that will then be decided in the European Council by some formula that allocates how much each country is going to pay. And that is what the Frugal Four and the Germans and everyone else is going to be focused on. How are we going to repay this borrowing? And who will bear a greater or lower burden? Right now, right at this moment, if the sums were done, the Italians would actually repay almost everything that they would borrow, which would therefore, even if it was in the form of grants, it would make it a loan. It's just a very long duration loan. So to the extent that long duration loans at low interest rate are a subsidization on a small slice of the debt, that's fine. But it does not solve Italy's 2.5 trillion euro debt load.
Thank you. So Desmond, we only have a little bit of time left, so I want to make sure that we get to our last topic, which is in fact yours, where you discuss the impact that Europe's struggles may have on the global economic recovery, and anything else you may want to add.
Okay, just before I get into my topic, I just wanted to raise one kind of question, which is the following: is that we're talking about Italy going to need $600 billion or so, from ECB buying their bonds, on a continual basis, because the markets won't really want to take up these bonds. My question is the following: is that in 2012, when the ECB bailed out Italy, they bailed them out subject to the Italians doing a whole bunch of reforms, that they managed to get rid of the Berlusconi government. They put in place Mario Monti, and they imposed conditions. My question right now is, how likely is it, that it would seem unreasonable to expect the ECB to buy $600 billion of bonds a year without any conditions, without any prospect of Italy improving its situation? So I think that that's something that really has to be looked at as well. What is the political context in Italy that they're really going to be doing reform? They seem to be balking at wanting to sign up on the ESM, precisely because there's some kind of condition. But now we're expecting to have the ECB buy $600 billion of bonds with no conditions that the situation is going to get any better.
But Desmond, I find this very disturbing, because in Europe, there is no intention of intervening in Hungary, where basically a brutal dictator is taking over a democratic country and transforming it into a dictatorship. And Europe is silent, okay? But then play politics, deciding who's going to be the next prime minister in Italy or in Greece or in Portugal. That is a recipe for disaster for Europe. This is the way in which we're going to go and hate each other. Because can you imagine a situation in which Trump is imposing to people in New York who should be the next governor or the next mayor of New York?
Well, we live under federal occupation here in DC, so yeah, that's pretty easy to imagine.
So if I could enter in that, I agree with Luigi's concerns, and this is why I consider the euro to remain a threat to the European project overall. If it continues to operate like this, I want to be optimistic that it will change. But addressing Desmond's question, I think by now it has been accepted that it was a mistake on the part of the ECB to be part of the Troika. That was a mistake. Institutions are very reluctant to accept blatant mistakes like that politicized unnecessarily the ECB. And no, going forward, I do not expect the ECB to repeat that mistake and re-enter into discussions of conditionality with any member state. It's not the ECB's job to be the police of the member state governments and enter into politics. And in my view, and I was there, I was on the governing council of the ECB in 2011 when this thing was going wrong. I think we messed up, and I think it was terrible that we did what Luigi just mentioned, effectively determine or influence who the next prime minister of Italy should be. This is unthinkable in a democracy. We don't want to be operating like that. This is, by the way, why the ECB moved away from the way it was operating. This is why the OMT effectively completely puts the onus on governments to decide with each other how they want to play the fiscal transfers game. And I agree with you, Desmond, that the ECB should not get into monetary financing. In my view, it has not gotten into monetary financing. But if it starts doing what you suggest, like, oh, from now on, we will buy all of Italy's debt and forget the rest, yeah, that's kind of not quantitative easing. I would agree with that. I don't expect them to do that, but that would be a different ballgame. But to the extent we have questions about, for example, some member states not behaving correctly, for example, running excessive budget deficits, which by the way, right now you can't be running budget deficits, and that's fine, that's within the rules. But if they are excessive in the future, or excessive external deficits or excessive surpluses. It's not the ECB's job to be imposing conditions on anybody, and I think now this has been accepted.
Desmond, do you want to close out with your views on the impact on the global situation?
Or yeah, I pick up, on some of the points that Ashoka made, that when we're looking at Europe, we really need to be looking at it in more global context. And Europe's not the only place that's in real trouble, that we've got this recession seems to be different from others, both in terms of its severity, but also in the fact that many countries are being hit at the same time. Ashoka mentioned the emerging markets, we're going to have just a whole bunch of defaults there. So this whole European story is playing out against that backdrop. The other thing I'd mention is that the eurozone economy is really very large, so it can really have a big impact on the rest of the world. You're talking about an economy that is only something like 10% smaller than that of the United States. So if things go wrong in Europe, we could get spillovers to the rest of the world. Now, the way I see it is that there are basically three channels through which those kind of spillovers can occur. The one that I think is the least important is just size of export markets. So if we get Europe in trouble, it means that they're not going to be demanding more stuff from other countries. And we're seeing that right now, with China. China already past the coronavirus stage, that they're on the mend, but they're finding that they can't sell their products to anybody because nobody's demanding. So if Italy's ready, if Europe is very weak, you've got the export channel. The other channel is the financial market channel. That's, the idea of what we saw with Lehman in September 2008, what you can get is a financial problem in one part of the global economy has spillovers to the rest of the financial system. And the third is the whole idea of globalization. So if we get Europe in trouble, what we could get is tensions between the United States and Europe on the trade side, coming with United States-China trade problems. This could really have very big impact for globalization. So let me just say a word on each of those three channels. So if we look at the export channel, the point I've made before is that the recession in Europe is a lot worse than it is in the rest of the world, certainly worse than the United States. The ECB itself is talking about a decline in 2020 between 8 and 12%. The United States is something like 6%. We're going to see worse in Italy. I agree with Ashoka. We're going to begin double digits in Italy and Spain. And then you've got the problem. It's not just what happens in 2020, it's what happens beyond 2020. That if you look at what occurred after 2008, Europe was really very slow to recover. The reason it's slow to recover, it's got the euro straitjacket. They can't use monetary and fiscal policy. I mean, certainly not in the periphery. And they've run pro-cyclical budget policies, because they've got big debt. They try to fix that. So we've got a problem there. We've got a problem that you could get a second wave of the coronavirus. You could get a hard Brexit. So the long story short version is that Europe is going to be very weak, and it's likely to stay weak for a while. That's going to be a drag on the rest of the economy, the global economy, because people won't be able to export. Now, when you look at the banking channel, the financial market channel, what concerns me is that we're talking about in Europe, most of the credit is intermediated through the banks. So it's like 75, 80% intermediated through the banks. And we've gone into this crisis with the banks not really being in the greatest position. They didn't really take advantage of the 10 years to get in as strong a position as the US banks. And now what we've got is we've got a shock that these banks are being subjected to in now that is way worse than what they were subjected to in 2008, 2009. And more to the point is that the shock that the banks are being subjected to now is worse than the worst case scenario in the stress test that they were being subjected. So, my expectation is that when we get these very deep recessions, what we're going to see is we're going to see non-performing loans really just balloon. And obviously the weak link in this is the Italian banking system. Just from a global point of view, it's of concern because you're talking about a banking system that's $4 trillion. And the banking system in Italy, they've gone into this with relatively high non-performing loans to begin with. It's around about 7% of their balance sheet, but 14% of their balance sheet are Italian government bonds, which are questionable what their value is. So now if we have a very deep recession in Italy, we're going to see non-performing loans go up very high, and you can get a banking crisis in Italy. It's not difficult to see how that occurs the next year or two. And the reason that has to be concerned is that foreigners have got a lot of exposure to Italy. So, if I look at the public debt in Italy, you've got the reason that public debt in Italy has done reasonably well is because the Italian banks have been buying the bonds. You get into this doom loop, and you've got foreigners exposed to the public sector in Italy by $1 trillion. If you take the banks as well, you've really got a problem. So just the last point I'd make is the threat to the international trading system. I'd say that before the pandemic, we had a problem between the United States and Germany. The United States complaining that Germany had too high a current account surplus. They're running a current account surplus of about 8% of GDP. The United States was also saying that what the Germans were doing is they were using the euro for currency manipulation, that they were enjoying a very much cheaper currency than they would have if they didn't have the Deutsche Mark. So my concern is that now, because Europe's going to have a deeper recession than the United States, we're going to see the ECB having a looser monetary policy than the United States. That's likely to mean that the dollar keeps strengthening against the euro, and that's going to cause problems, together with the fact that Germany, the current account surplus in a deep recession is going to widen. So I think that for all these reasons, I can see Europe as adding to the kind of tensions that we've got between the United States and China. We now look like we're on the way to problems between the United States and Germany in trade relations. So for all of those three reasons, I can see Europe really providing quite a lot of problems for the global economy.
Well, on that optimistic note, I would like to once again thank our panelists and our audience. Thank you for joining us, and I will see you next time.